Today we're going to go over my best simple approach to 50 pips a day. We're going to talk about all the steps in detail. Stay tuned, traders. We'll be right back. G'day traders, I'm Stacey Burke from Stacey Burke Trading. It's Tuesday. We've already had an explosive start to the week. British pound and gold. We're going to review today not only the simple steps, we're going to talk about everything in detail. We're going to go over all the little aspects in terms of psychology as well, and understanding specifically the importance of yesterday's high and low and the importance of keeping things as simple as possible. Now again, just before we get started, thank you for hitting the like button. Again, a ton of tremendous feedback. Yesterday, got a couple of screenshots on the gold trades. A few traders also nailed the British pound. Friday and Thursday. Last week was a huge week. Questions as to whether or not traders should be trading going into December and Christmas. Again, whatever decisions you make regarding your own trading is your individual decision. You need to seek other advice in terms of taking trades unless, you know, for me, I trade other than the holidays, Christmas Eve day, Christmas Boxing Day, New Year's Eve day, New Year's Day. But otherwise, if the markets are open, I will trade them as per normal. Now, if the markets don't seem to be trading properly in terms of how they normally would behave, I'm very risk averse and I'll be hesitant to be concerned about necessarily even trading that or even trading that with anything that carries any more risk to it. So obviously reducing risk size. But if it doesn't feel right, again, I talk about, you know, I'm not looking for 50-50. We're looking for, right, not 50-50. We're looking for 90-10. And today that's what we're going to be talking about in detail. A lot of questions, a lot of traders getting caught. First mouse. We're going to go through some very simple things. And again, I'm going to encourage traders to print off your screenshots. Go through your charts, understand exactly what we're talking about in terms of the engulfments and pin hammers at the high of the day, not just blindly getting in because there's an engulfment, understanding when it is the high of the day and when we're looking for a second leg, understanding when it's a blow-off move with 3 extensions, understanding when we have a second leg after 3 pushes and a second leg locking in the high for an M structure or a low for a W structure before that reversal comes, but also the importance of the timing of those structures presenting. So again, coming back to just talking about yesterday's high and low. Now we're going to go over some screenshots to understand the importance of those levels. So again, when those levels are broken, immediately that triggers other time frame traders into the market. And depending on when those levels are broken, in terms of timings, that can also create counter-sided trading because, as you're aware, the golden rule is that nobody gets a free lunch. So if other time frame traders are triggered into the market, especially on gold, the British pound, then the market may pull back 25, 50 pips or more before that trade continues. And again, that puts a lot of heat and stress into other time frame traders. Those are the kind of moves that traders often will be counter trending and getting pips, but again, the importance of taking profits, learning to take a profit. The popcorn trade, you're in a 50 pip trade, you're holding on, you go to break even, you come back later and the market's rolling over for the continuation because it has other time frame traders and the true trend may have been down or long depending on the direction that you're in. But again, just the importance of those levels creating a boundary for either attracting other time frame traders and a move continuing. The 3 things that markets do: they break out, they pull back, and they continue, or they break out, they pull back, and they reverse, as we saw last night on gold, or they break out, they pull back, and they go into a trading range. So always be asking yourself certain questions. Who is getting into the market? What would the other traders be thinking right now? Other time frames. So one thing that we haven't talked a lot about is time compression. So multiple time frame traders. People ask me about, well, do you use the 4 hour or do you use the moving averages on the 1 hour? Every time frame is the same in terms of how it behaves. So if you're trying to align all of your time frames up, chances are when they all line up, you're going to be buying up high or selling down low. Unless, of course, you're trading with the swings on those larger time frames. So with our markets, with these currency markets, if you've been following me long enough by now, you understand that these levels, yesterday's high and low, will often be an area for reversal trades to occur, but also breakout pullbacks to layer on top of or below of a previous day's range. Not only necessarily on the current day, but later in the week. We have Monday, Tuesday, our initial balance, setting highs and lows for the trading range for the week. And again, we can look at measured expansions of those ranges for profit targets as the week evolves, if it's making higher highs or lower lows. Then we talk about the high and low of the day. So if we have not violated yesterday's high or low, that means we are currently an inside day. If we are an inside day, we need an engulfment to lock in a high or a low and be confirmed with either, if the market locks in the high, maybe it will drop down again below round numbers or at round numbers and push back into it. 1 push, 2 push, 3 pushes before dropping away. But if an engulfment by itself is merely now a high of the day, so again, traders are trading breaks of previous day's boundaries on engulfments and shorting them or going long on them, but that merely is designated. Now we have a low of the day or a high of the day in place. Now we need the market to go back and retest that or work back into it. And again, the timing window is critical. We had an example last week or the week before on gold where they locked in the high in Asia after a 1, 2, 3 in the gap time. And then the market worked its way inside in a creeping trend inside of that peak formation before dropping away in the Europe-London 12 candle window. So traders were waiting for it to come back to the high, but the high of the day was already locked in place, meaning that we don't counter trend the peak formation. So we should have been looking for shorts right off the bat into that session. So the engulfment and then the pin hammer typically is the stop hunt back into the short or down into the long trade after they've locked it in, if that market is on a third leg and they're going to shift the market and move away. So again, the timing window, 8 to 11 p.m. for Asia, 2 to 5 a.m. Europe and London, 8 to 11 a.m. for New York Eastern Standard Time. Now, you've heard me mention before that first hour will often be a stop hunt trap before the trade. Now, understanding if we're jammed down low, if Asia has been the high or Asia then London's been the high and we're down low and they're working the low, that first hour will still typically have a stop hunt back down into the peak formation low, jamming traders in down low before shifting away. Or as we saw in the pound last night, they lock in that high heading into just prior to the US 12 candle window. They locked in a third level, 1, 2, 3 in the upper quarter before consolidating sideways underneath and dropping away in the equities hour. So the equities hour, especially in that US session, is so important. And in a majority of the cases, they will typically take traders back in the wrong direction into the peak formation before shifting away. Now last night was a great example on the pound of where we had a 1, 2, 3 prior to the US session. So the equities hour took off and moved 50 pips, which was the stop hunt, okay, back into the London trade. So remember, again, nobody gets a free lunch. when you start to step back and look at the big picture, as the day evolves and the range expands, the further we get away from the extreme, the greater our potential risk-reward opportunities become. So some of the best trades come in the US session because they expand the range over the 2 sessions heading into the US. Now, traders ask questions all the time, but yet one of the most important things to kind of comprehend is that every single day is different as the day evolves. So we don't know what the market's going to do. It could be a Wednesday, it could be the middle of the week, but they may stay inside as an inside day, catching traders trying to trade in both directions before dropping away at the US session to the low of the week and moving it back up, and vice versa on a Thursday, Friday. So again, understanding that as the day evolves, we still want to be working from the high or the low of the day. Timing window, very important. Now the round numbers, a lot of questions again about round numbers. 00 and 50 pip boxes, so we can have 100 pip boxes that the market is trading around. It may be trading into zeros before dropping away. It will move towards the double zeros. Now, the quarter levels, when we look at the chart, we want to look and say to ourselves, is the market trapping traders in an upper quarter above zeros before shifting away? So traders are trying to go long off a zero. Meanwhile, they're trapping volume up top before dropping away. And sometimes they may do it between 75 and double zeros. They may do a 50, 60, 100 pip stop hunt and go through 50 into the quarter between 50 and 75 in that US session equity hour at the end of that hour before locking it in and then dropping it 50 or 100 pips back in the other direction. So the quarter levels will often be where the extended stop hunt occurs to, or where they trap volume, okay, down low or up high before shifting away and moving away from that area that's been trading there for maybe 3, 6, sometimes 8 hours or more. So again, round numbers, where is your box? Try to identify and have a thesis of where your box is. It may just be a 50 pip box. One of the questions I get is, what do I think about Bitcoin? What do I think about the Aussie dollar? What do I think about the Canadian dollar? I don't trade those. I trade gold and the pound. Pound Aussie, but even in the last week, I've only been looking at the pound. So whatever instrument you're trading, you need to look at it and say to yourself, does it even move 50 pips? Part of the reason I don't look at those other pairs is you may only get one 50 pip trade in a week because they move it up high over 3 days for a move down or up. Now we go through phases where some of those pairs will be trending and they'll be moving well. But generally speaking, every single day, there's at least 50 pips in 1 or 3 of those sessions. So I'm looking for the behaviors that show up consistently over and over again, that are duplicatable, that I can reproduce in terms of my process, and understanding that I want to keep things as simple and zero stress free as I can. I'm looking for something at the high of the day. I'm not looking to try and sell the high. I'm looking for the market to confirm the trade for me and then position myself in the market with a 1 bar stop, okay, 1 bar stop, and I'm targeting 25, 50, 75, 100 pips or more. Now you may be in Asia. You might be trading the Aussie dollar. You may only be targeting 25 pips. So understanding when to recognize when that trade may have reached its full movement. If it's a stop hunt and the range is only 25 pips, they may only move at 25. But if I'm trading gold and I'm selling up high and the low of the day is 50 or 75 pips away, the first move may be 25 and I may need to sit there for an hour before it drops the second 50. We saw yesterday it moved 25, moved 50, pulled back 50 and dropped 100. So understanding, take profits, knowing what your target is. I program all my profit targets in right away. Last night was a great example on gold. It moved 50 pips in 3 minutes once it broke the high of that initial hour at the US session. 3 minutes, 50 pips. So profit targets will depend on the session, the timings, and the range that's already developed. As I just said, as the day evolves. You may have Asia this morning in gold, Asia's had a big range. So now we have a high and a low that is spread further apart. If at some point that market does come back, we have a high and a low now that's roughly 75, 100 pips. Now that we also may get a continuation where they could do a measured move of that range to the yesterday's high and still go another 50 or 75 pips in the other direction. So London, as we open up, depending on how that market trades, may put in the high of the day, and we may see the US bring that back down, or London may come back down inside of the Asian range and the US continue that move back up. So again, it's important to understand the instrument that you're trading. If you're looking for 50 pips, and very rarely does it give a 50 pip trade, that may be part of the reason you're getting frustrated as to why you're not getting 50 pips. So if you're trading gold and you're taking 50 and it moves 100, the next question you want to ask yourself is, on certain trade setups, how can I squeeze more out of a winning trade? When would I be able to identify which trades have the potential to be moving more than 50 pips? And that's where we talk about geometry, measured moves. Yesterday was a good example because they had an explosive measured move that went through to the previous day's low. So again, understanding the psychology behind hitting those levels. If the market's taking 6-8 hours to get down to a previous day's low or high, think about what they're trying to do. They've already moved the market down. They're getting traders chasing it down on swings. The indicators are getting traders to short the market. They're building volume up for a possible move back later. They're still inside of yesterday's range, but at the very end, we're going to trigger other time frame traders into the market and activate their stops at not only the high of the day, but maybe yesterday's high as well. So again, attracting more volume into the market, other time frame traders, 4-hour, daily, they will have stops in the market. Traders who are short will have stops in the market on the current day. Traders who are short may have profit target orders down there. So the buy orders could be building on both sides of the market. And then when the market does decide to shift and it jams them in and it moves, that is part of the reason why it moves so fast. There are a lot of stop orders to go through quickly, but also it will shift away partly from building all those stop loss orders up in order to to ensure that those traders that are caught now cannot get out of a losing position, or their loss increases, and very, very quickly. As I said, the market moved at 50 pips in 3 minutes before pulling back for 25 minutes and then going another 50 straight through in the same sort of time frame. So 3 pushes into a low or a high. Which way are they working? Are they working down? If they're working down and they're not going anywhere, that's a coil, that's a squeeze for an explosive move in the opposite direction. If they're breaking down and making new lows and pulling back, they're probably going to keep rolling over until that market finally capitulates in a vertical move and has a V-bottom reversal, or it jams into a squeeze into the next 12 candle window for an explosive move back in the other direction. So keep asking yourself, which way are they working the market? If they work it down and then pull it back up before we head into the next session, chances are that market could be rolling over again for a measured move. 3 pushes into a level and then possibly also culminating on a 1, 2, 3. We won't always get those, but often that 1, 2, 3, the 3-bar pattern, is often what we'll see at the end of a move. And that when you may not see that on every time frame, but every final move will have it on 1 or more time frames. So sometimes you'll see it on the 1 minute. It may be the last 15-minute bar, and they'll have a 1, 2, 3 that hits the high or hits the low before reversing. But on our charts, we will see this quite a bit. There will be a 45-minute to 60-minute push in one direction. And again, we've talked about this, that 45 to 60 minutes typically will occur in that first hour. If that first hour doesn't do anything, be prepared for that middle hour to make its move. Very important. So again, profit targets depending on the session times and ranges. So just to review, again, I'm mainly only trading gold, but I have the pound up. I've just been trading gold. It moves every single day in pretty much every session. So I've just developed my feel for that market, and that's where I'm trading right now. Yesterday's high and low are very significant, and then again I'm asking myself constantly, are they working towards yesterday's high or yesterday's low? If they are and we don't get there, have they locked in a high or low for today yet? Have they put a peak formation in? Sometimes they will do it in the rollover. That's very important information. They can be locking that in just as we're heading into the Asian session. Engulfments, okay? The timing window often is where we'll get a peak formation. So again, we look for the stop hunt, possibly a false break. Today we saw them jam in before shifting away in the Asian 12 candle window for gold. And that was after the US session had come down and been jamming them in on yesterday's low, on Friday's low. And then heading into Asia, we had the reversal and bing, straight up. So round number boxes. Okay, we're looking for double zeros and 50s to be major levels, and those quarter levels will often be the extended stop hunt or a level for trapping volume up high or down low before they shift the market away from the round numbers. Engulfments and pin hammers. So again, understanding it, you want a middle structure for your M or your W. Okay, so often we've talked about traders getting caught selling the first pin, but there's been no evidence of a high or low being locked in place. To only watch them come back for a second leg before locking that in, and we look back and we see there's 3 pushes to the high or 3 pushes to the low with the extended or shortened M or W formation. So middle structure or extended 3 legs, if you're not sure what those are, go back and review the video on M's and W's, the 3 types, and go over your charts, print them off. Start identifying with 2 or 3 setups. Look for stuff that you resonate with. As I've talked about before, I'm naturally more bearish than I am bullish. So sometimes the long trades are a bit harder for me to recognize visually, but I understand that when I'm down low and they're jamming me in, I'm looking for a long trade. But typically I'm much more bearish and able to short sell easier than I am to go long, just how I'm wired. But I keep working on that. So 50 pips a day, even, as I said last week, even if you get 50 pips a week, and you can learn to scale that up in size and really refine and master your process, that is scalable. Now, just to come back to some questions regarding the ASIC ruling regarding the reduced margin for Forex and CFDs, whatever, everybody's situation will be unique. Don't worry about that. Worry about mastering extracting 50 pips a day out of the market and mastering your process. The money will be available if you can do that. So even if you start small and you need to grow it, you should be starting small until you can grow this every single day. So the leverage is not the issue. Mastering your process should be your primary focus. For other traders who are already doing that, the dilemma will be to either get to a level where they can go to the sophisticated investor or the pro account, or they put more money in just to cover the margins and they keep growing that account until that growth has compounded and the margins are not an issue. So yes, it's not an ideal situation, but typically I guess it's like that everywhere else in the world. The most important thing is to master being able to execute, not only taking 50 pips out of the market, but also not giving it back, knowing when not to trade, knowing not to take trades outside of your trading plan. Those are the things that will end up causing you to do things that are irrational, impulsive, illogical, and it will force you to engage in behavior that you shouldn't be going into, because that can lead into a whole nother mushroom effect that can, as we talk about, one trade can undo all of the good work that you've done. So very important. Again, I read something on Twitter yesterday. Great trader in Sydney. He's made over $1 million trading in the equities, and yesterday he showed up at work hungover a minute before he was supposed to start, and he lost 10 grand yesterday. So one day, 10 grand. And that's a major psychological blow, knowing that you did everything that you shouldn't have done. He even said in there that he wasn't even supposed to trade yesterday. So important to keep your mind right. I use the Headspace meditation app before every session, just to reset, exercise, get rid of the stress, stay focused. Your why are you trading? Master the process, master your psychology, understand what's going on in the bigger picture as the day's evolving. So again, just keeping it simple, understanding all the steps in your process, mastering all the little nuances and particulars, and understanding what it is that you're looking for, how it should be behaving, knowing a great question just before we close from a trader: how do you recognize, or how do you know when the trade isn't going your way, and when should you cut it if it hasn't hit your stop? Well, that's a great question, but you stare at these charts long enough and you'll start to understand, number one, if you've got the right setup, because if you're not sure, that's right away, it's 50-50. Okay, and as we said, if I'm sitting at the screen and I get into the market and then I'm sitting there going, what am I doing? That's where you've got to make the hard, fast call to cut that trade, because I'd rather just take that loss or get out at break even right away than be 50-50. When it's 90-10, because if you got your best trade setups and you've got the patterns locked in, that it's been a stop hunt, because again, we talk about it's about the money. Every single trade on every time frame. So this is where you're coming back to multiple time frames. Do you line up all your time frames? Every single time frame's the same. If you get a signal on the 4 hour, guess what the next bar is probably going to do on the 4 hour? It's probably going to come back into that trade for 50% retracement, maybe 25% retracement, which is on a smaller time frame. Your 1 hour, your 15 minute, your 5 minute, and your 1 minute, all working back 25 to 50 pips in the other direction, depending on the pair that you're trading. So when people say, do you use the moving averages and all that stuff? You don't need any of that stuff. You need to understand how all those time frames align when they roll over together. So 5 1-minute candles is a 5-minute bar. 3 5-minute candles, 15 1-minute candles is a 15-minute bar. 4 15-minute candles, 60 1-minute candles, and 12 5-minute candles is a 1 hour bar. All those sort of things. And then you've got your 4 hours. So if you have 3 1 hour bars, that's a 1, 2, 3. That sort of thinking. So if you're at the high after 3 hours, you might be seeing a 15-minute pattern show up, or some traders are using the 5-minute bars, whatever. But understanding the multiple time frames are working together. So if you're trading a trend on the 4 hour, you might get a short signal and they might go back 75 pips before it rolls over again. So it may not hit your stop, but you're 75 pips underwater, whereas the 15-minute trader just got 50 pips. That's the sort of thinking that I'm thinking about when I'm looking at the charts. Understanding the rollover, the 4 hour cycle, the 1 hour cycle, the 15-minute rotations, the 5 and the 1 minute. When I'm up high or down low, I am looking to see how we're behaving, what number levels we're at. Is this the first leg up? Is it the second leg? Have we seen 3 pushes? Can I count 3 pushes? Is that an M or a W? That's the sort of thinking. You've got to constantly be processing information. But when you've seen these and you're looking for certain setups enough, you'll understand that the timing window is critical, especially in that equities hour, and especially in London and New York. So let's take a look at yesterday's charts. Again, thank you for a ton of great feedback. Yesterday, traders, David, killed gold. The British pound, a couple of traders have sent me, they nailed it right off the round numbers, up high into the US session, straight down 50 pips. Congratulations. I love it. It's time to get your money back. These markets are designed to take your money. So let's keep it simple, stay disciplined, master your process, focus on mastering your process. Don't worry about the leverage, don't worry about cryptos and all that. Every market's the same. They're designed to take your money. Take the money from the many and give it to the few. Master your process, work from the highs and the lows, keep it simple, zero stress trading, and may the markets go with you.
Good day, trader. Stacey Burke from Stacey Burke Trading. Just continuing our discussion on simple Forex trading and looking at our 12 candle window and all the simple steps that are designed to keep things as simple as possible, but also zero stress trading. High probability asymmetrical risk reward. We're looking at gold from Friday. We can look at Thursday as well. A great example on Thursday of a day that did not at any point hit the previous day's high and low. Now we did have a low of the day structure in place that we can project across. And again, I mentioned that when a day like this occurs and it's trading inside, we need the market to give us a high or a low. We will look at this with our 12 candle window in a second. But again, we get an engulfment in our Asian 12 candle window, and that is a high of the day formation. Now, this by itself may not be a trade unless we have, of course, some kind of confirming stop hunt, continuation, reversal. But at this stage, this is a high of the day structure because we have not broken any of these other levels. So we have a low of the day structure in place, and we have a high of the day. But when the market comes back a second time to that level, now we have a market that is working the high. So again, understanding we're inside of the previous day's levels, we're down low. We're down low near the previous day's low box. We talked about price being in a box. There's your box. There's the previous day's high that the market traded into before reversing. And then they work inside of the low of the day and they start working the high. They come back a second time, no engulfment, no pin hammer. They come back a third time and engulf the third push to the high just near the end of the Asian window. So again, we have a middle structure. So again, we talk about geometry, understanding you're looking for a rectangle up top or a rectangle down below. Sometimes it can be a 25 pip box. But this is an example of the market forming a high, coming back a second time, coming back a third time before engulfing. As we head into our Europe-London 12 candle window, then we get a 1, 2, 3, which is the stop hunt against traders that are short. And again, in your head, you can do the math and figure out what other time frame traders are getting caught buying long. That would be your hourly traders. Your 4-hour trader might be getting caught long somewhere out here, buying high, before rolling over and hitting the low of the day. Now again, we're jamming traders in. We're expecting this to go all the way down through the previous day's low. It doesn't get there. We get our 3-bar reversal. We're in the gap time, but again, this is an example of a 3-bar reversal. The market then pulls back, comes back down a second time. There's our middle structure for a W formation. Now we have a low of the day in place with a shortened W. Okay, we're at the low of the day. There's our W. Unless this market rolls over and takes the W out, that's the low of the day now. So we're expecting then that the market will come back and work into the low before we take off in the US session, which they do. 1, 2, pin through down to the low at the beginning, in the gap, just still in the gap time. Then they come up, push down one more time before reversing, and then taking back out the high of the day. So again, clearly, without anything on the chart, you can see the behavior. If we put our 12 candle window on here, it's the same thing. I'll just get rid of this high-low of the week indicator. But we have a market that now we can identify our 12 candle windows. They put a high of the session in place before locking in the low. And then pulling back, working back into our shortened W formation before shifting away in 1 push, 2 pushes, 3 pushes to the high. And again, we talked about this the other day. Traders selling that first leg at the high when it's a breakout at this stage on the second push, pulling back and then hitting it a third time, which is again a stop hunt on other traders who were in the money from the previous night's US session. So if we go back and just look at the next day, Friday, you can see this behavior again. Clearly they came down to the previous day's low before reversing. 2-bar reversal in the gap time. So an example again of trading in the gap time when we are at the high or low of the day, when a significant level has been broken. Our most recent swing high was in the Europe-London 12 candle window. The market immediately, 1 push pulls back, 2 pushes pulls back, and then 1, 2, 3 to the high before consolidating, bear pin hammer for the pullback into consolidation. So again, understanding that we get the 1, 2, 3, the sideways price action, then the bear pin hammer, which if you notice, closes underneath the opening price of our last push to the high, but more importantly, the timing window. Then the next candle closes and engulfs all of that upper structure, meaning that now they are trapped before consolidating and then dropping away, coming back to traders who may have caught that second leg back up, stopping them out at break even or with a small loss or whatnot. We put our 12 candle window on there. It's the same thing. Again, I'll just get rid of this high-low indicator for today. The market came off of round numbers, giving us a peak formation. We're inside still. Gives us a peak formation before dropping down and then working back in 3 pushes just prior in the gap time, prior to the Europe London 12 candle window, and then coming down 1, 2, 3. The market pulled back above 50, trapping volume in that quarter above 50 beneath the peak formation before dropping, pulling back again, and then working the low in 3 pushes before the 1, 2, 3 stop hunt and pin to the high for a 50 pip plus move to the high, hitting stops above the swing high for shorts that were in the market off of this level. Again, other time frame traders would be in the market 4 hour, 1 hour, but not until the market capitulates and hits the previous day's low before reversing do we get other time frame traders, possibly more 4 hour and daily end of day traders in the market. And again, we see the 1 push, 2 pushes, 1, 2, 3 to the high, consolidation, bear pin hammer. Our M structure on a smaller time frame, this would be very well defined. But again, just understanding the timing window is what's critical. And this is a 3-legged move locking in the high of the day. If we look at today, Monday, we'll go back and put this. Monday again clearly shows same sort of behavior, gradual creeping trend down that eventually blows off in the direction of the trend. 1 push, 2 pushes, 3 pushes for the explosive move back through the high of the Asian session for coming straight back down. 1 push, 2 pushes, and then 1, 2, 3 into this morning's Asian session. We have our structure for a measured move. We have a couple scenarios here. We could do the bigger measurement, but we also may have a market that has possibly been working the low, as we can see, day 0 situation. So the market was working, jamming into the low. All these peak formations have been worked into, locking in these levels. We could see a possible still bigger day to come on gold, depending on how they behave heading into the next 12 candle window. But just keeping things simple, looking for the obvious of when the market could be locking in a low, locking in the high, and understanding also the difference between a breakout and a continuation. Again, if we look at this on a regular 12 candle window, the timing window, you can see the same things occur. We came below the round numbers for the continuation through 50 pip box. They dropped it below the round numbers again, came back up to double zeros before dropping it down 100 pips. Pulled it back up above 50, jammed traders into the previous day's low, which was at the 50 level, before the fast, strong move, pinning up towards the double zeros through the high of the day and dropping it back in before going into consolidation. British pound yesterday is a fantastic example. So big gap on the open on Monday morning. We also had a potential V-bottom reset on Friday, locking in a peak formation low. Again, I mentioned this to a few traders that we could look at this as a possible measured move because that market gapped on the open. We now have one full expansion acting as potential support as we head into the next Europe London 12 candle window. There's a couple of ways to view that expansion, but again, easiest way that I typically will do it, and we'll look at this on the numbers, is just to look at the round numbers. Other traders sometimes will use the 1.5 to 1 full expansion as a possible target, and this market did a 1.5 expansion of Friday's range. Most importantly, though, this market broke out of the previous day's high at the open, pulled back and layered on top of it before heading into the Europe London 12 candle window. So before we even head into the Europe London 12 candle window, we're already outside of the previous day's range. This structure by itself is a potential for measuring the geometry for the day. The market goes up. No evidence of a high being locked in place. Continues to go up. Again, no evidence of a high possibly starting though. There's no engulfment of a high structure. We have a 3-bar reversal, but it stays on top of the open of that last bull candle. We get 1 push, 2 pushes, and then a 1, 2, 3 before the large engulfment of this bear candle in the gap time just before the last candle, just before the US session 12 candle window. We have higher lows and we have a structure now, higher structure for geometry. You'll notice that consolidation in the beginning of the 12 candle window layered underneath of that upper higher low. So again, we have our M structure in place. 1 push, 2 pushes, middle structure, 1, 2, 3 to the high, large engulfment. This whole upper structure was trapped. They shifted sideways, and then the equities hour engulfs and pulls away. And again, equities hour became the stop hunt back towards the traders who were long at the beginning of the Asian session. The market hits the previous day's high, takes out the stops, and goes into consolidation. We'll look at this on the 12 candle window. And again, we can leave that on there because it's the high and low of the week still. But again, we had our Asian session. They layered on top of the blue tracer, came back inside and then popped back above. And again, even just measuring the high and low of this last expansion gives us 3 full expansions of that high and low at the end of the Asian 12 candle window. The market, though, if you'll notice more importantly, traded off of double zeros from 50 to double zeros, layered inside, layered on top of the quarter, went through 50 up to the double zeros before pulling back and then working its way in 3 pushes into and just above the quarter level, the highest low, the high bull. The low of that candle was at the quarter level. Savvy traders counted the bars and shorted it in the stop hunt hour just prior to the 12 candle window, selling the very high of the day on a 1, 2, 3. The fast, strong move in the consolidation after the first hour, they're at break even and the market races away for a move back towards the low, but also a measured move of the upper structure. So we have a couple of options to measure. The last upper structure can be measured. But again, just keeping it simple, looking at the numbers. The market was a quarter above the range. They pulled back inside double zeros. Traders are hoping to get down to double zeros, but again, it hits the stops and goes into consolidation at the previous day's high. The high and low of the sessions takes precedent as the market goes sideways. I'd be taking profits. So hopefully you got value from today's video, traders. Keep it super simple. Again, a very simple model. Looking at previous days' highs and lows, you see Friday on the British pound, they broke through before pulling back and continuing for a measured move. Great example again, 1 full expansion of the range. The market ends on a V bottom. It doesn't quite get there. This is your telltale sign to exit the trade. It would be a 1.5, but also on our numbers that was at 50 before pulling back for more than almost 100 pips back in the other direction. So again, these levels become support or resistance. It's a box. The market broke out of the box, continued to trade, pulled back, went into consolidation, and then pulled back inside of the range on Monday. Keep it simple, traders. Stay disciplined, stay focused. Hopefully you got value from today's session. Again, thank you for hitting the like button. Thank you for all the emails and comments. Again, just working back through everything as fast as I can. Keep it going. Keep it simple. Stay disciplined. Stay focused. 1% better every single day. And may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.